A margin call is a critical event in trading that occurs when a trader's account equity falls below the broker's required margin level. In leveraged trading, where traders can control large positions with a small deposit margin, market fluctuations can quickly lead to significant gains or losses. A margin call is essentially a demand from the broker for the trader to deposit additional funds to maintain their positions or risk having those positions liquidated to cover the shortfall. Understanding margin call. Margin is the collateral traders deposit to open and maintain leveraged positions. Brokers typically require a minimum margin to ensure traders can cover potential losses. When the value of the trader's account drops due to unfavorable market movements, the account equity may fall below the maintenance margin level set by the broker. This triggers a margin call, prompting the trader to restore the account balance. For example, if a trader opens a $100,000 position in Forex with a 1% margin requirement, they only need $1,000 as collateral. However, if the market moves against them and their equity falls below the maintenance margin threshold, the broker will issue a margin call. What happens during a margin call? Notification. The broker notifies the trader about the shortfall via the trading platform, email, or other means. Action required. The trader must deposit additional funds to bring the account equity back above the required margin level. Alternatively, they can close some or all positions to reduce margin usage. Automatic liquidation. If the trader fails to act promptly, the broker may liquidate open positions to prevent further losses and secure the required margin. Causes of margin call. 1. High leverage. Excessive leverage amplifies losses, increasing the likelihood of a margin call. Second, volatile markets. Sudden market swings can quickly erode account equity, especially during news events or low liquidity periods. 3. Inadequate risk management. Poor strategies, such as oversized positions or a lack of stop-loss orders, contribute to margin calls. Avoiding margin calls. To minimize the risk of a margin call, traders should use conservative leverage levels, implement effective risk management strategies, such as setting stop-loss orders, monitor account equity regularly, keep a buffer of free margin to withstand market volatility. A margin call serves as a safeguard for brokers, but can be a critical setback for traders. Understanding how margin works, managing risk effectively, and maintaining adequate account equity are essential to avoid margin calls and maintain long-term trading success.